I'm Scarlet Fu. This is ETF IQ, where we focus on the access, risks, and rewards offered by exchange-traded funds. Fear factor. The U.S. and Iran raised the stakes in the Middle East. How do investors set up for a volatile 2020? Where active beats passive. PIMCO's Jerome Schneider manages the largest actively managed bond ETF. We get his outlook for this year. And sacred cows. How a focus on free cash flow will lead you straight to a pair of cattle-themed funds. Love them or hate them, ETFs are here to stay, and we watch their flows for signs of broader market shifts. While Bloomberg's ETF master, Eric Balchunas, watches them, he tells me about it. And he's here now to show us the latest.
Thank you, Scarlett. Yeah, so sometimes the first week of the year, you get some things in there that will tell you a lot about what's going to happen. But I think what we're seeing more is a little spillover from last year. I don't see really anything different. Despite the geopolitical drama, people largely staying invested. So let's look. Some interesting things. XLI at the top is that's industrials. And EEM, that's emerging markets by traders like it. There's a broad market, there's some semis, the Qs, nothing too out of the ordinary. But seeing two sectors here makes me want to look at the sectors. Let's look at sector ETFs. Sometimes trends start in the sectors and then make their way out. But honestly, there's not a ton new here. Look, you got financials and industrials at top, technology. So risk is still on here. Look at where the outflows are coming out of in January. Utilities and staples. That tells you a lot about people not being concerned about what they're seeing on the news right now. Let's also look at our risk on and risk off proprietary indexes of flows. And you can see it's as obvious as day. People are going into the risk on stuff, which is like discretionary, semis, EM, growth, small caps, and they're coming out of stuff like staples, utilities, short-term debt, and value. So, Scarlett, nothing really is phasing investors. A lot of the inertia from last year is just coming right into this year.
All right, continuation from 2019 then. So let's bring in Mike Venuto. He is CIO of Toroso Investments, and Vildana Heinrich, a cross-asset reporter for Bloomberg News. Mike, let me start with you because we got the everything rally in 2019 where everything worked. You had the 60-40 traditional allocation. That worked, although risk on worked even better. With all the tensions in the Middle East right now, how are you positioned for this year?
So we started to position more conservatively late in 2019. So we brought in things like longer-term treasuries. We're not the ones scared of rates going up. We're more concerned with their behavior, inversely correlated to things like BTOL, things like gold. We've been always a conservative investor, and it's nice to accept the gift we got last year, and let's protect some of those gains.
All right, we'll get to BTOL in a moment, but Vildana, you've been talking to market participants here, and one comment that really got my attention was how Iran has replaced trade war as the biggest risk to markets. What are you hearing from folks?
Iran has certainly replaced some of the trade headlines that we've been getting over the last couple of weeks. We did see knee-jerk reactions in the market, in stocks, in oil, but we did have President Trump come out and say that Iran seems to be standing down. Investors I speak with, they tell me that they're much more focused on fundamentals. They're looking forward to the earnings season that's supposed to kick in next week. So there is this sort of sense that maybe cooler heads will prevail. Inflows into XLI, XLE, but we'll see if we can maintain those now that things seem to be de-escalating.
And Mike, one of the ETFs in your picks here I want to hone in on is BTAL.
Sure.
This is an ETF I hear over and over from the aficionados. A lot of ETF nerds love this thing. It reminds me of a Terrence Malick movie. All the critics love it, but no regular people have ever heard of it.
Explain what it is first.
BTAL goes long, low beta stocks and short, high beta stocks. It's a hedge fund, basically, in an ETF. Explain to a regular person why this might make sense in a portfolio.
Okay, so the short version is you're getting $1 worth of insurance for 50 cents. That's been the historical return. So most things that you want insurance, you're paying more than what you could get out of it, right? So this is an asymmetric risk-return profile. Nobody knows if we're going to have a good market, bad market this year, but we know the tinder is ripe. If we get a spark like the Iran situation she was describing, having something like this in there that for 50 cents can protect $1 is beautiful.
Yeah, you'll take that. Let's turn to ETF issuers now, Vildana, which Mike, of course, is one. Who are the winners and losers of 2019? And I guess to that extent, will the big brands win again in 2020?
That's a really good question. If we look back to 2019, we had BlackRock come out on top again for the 6th straight year. They took in $116 billion in terms of their cash haul, followed by Vanguard, $104 billion. And together, those two, they made up 2/3 of the entire haul. followed by State Street, Charles Schwab. They're taking in about $23, $24 billion each. But it does set the stage in terms of 2020 for some of these bigger players to continue dominating the market. And it does also show how difficult it has been for smaller issuers in this very competitive environment.
I was just going to say, you don't see Mike in there in that league table because he's
yet.
an indie issuer. Not yet, he says. But he works with some pretty high-profile issuers.
Yeah, he's in the top 70, I think. Yeah, and what's interesting about you, a white label issuer, normally they're taking very, very tiny issuer, people who have ideas. You have taken on bigger clients like SoFi. Talk a little bit about what's going on there, why the bigger clients seem to be going to your firm.
So the original white labelers all came out with what we kind of call that halo, right? They said if I put the halo of an ETF on a strategy and I do the field of dreams, if I build it, they will come. That era is kind of past, right? Now what we're into is thinking more of the trust of the ETF structure, more of what we think of as the ETF as a service, right? You take something that's a good strategy now or is efficient today and you make it better by putting it in the ETF wrapper. So for SoFi, they were able to engage the cohorts better. For Blue Cross Blue Shields and Aware, we were able to make it more accessible. For our friends with the Risk Parity Fund, we were able to take something and make it more tax efficient. So we had a great rookie year. We did 8 funds and $500 million in assets. So we're glad to be in this space now.
You have to see the benefits of the ETF structure for what it is rather than just tacking it on to your existing offerings. Vildana, speaking of white label issuers, what happened with ETF MG, the issuer of Hack, losing a lawsuit to NASDAQ? I feel like it didn't get as much attention as it should have.
Because it happened during the holiday week. So a couple weeks ago, we had NASDAQ win its $78 million breach of contract suit against ETF MG. We had ETF MG come out and say that it's denying the suit, it will appeal the suit. NASDAQ, of course, had said that ETF MG was misappropriating some of the profits from Hack, which is its cybersecurity ETF. But NASDAQ told Bloomberg that this was a really big victory for the ETF industry.
And Mike, you are a white label issuer. Has this stained that world of white label issuers? Are you concerned?
I mean, for us, it's an opportunity because we're out there selling trust. To me, this isn't really about white labeling. This is about, if you read the ruling from Judge Engelmayer, it's about breaking trust and breaking contracts, right? Like, I don't know what actually happened, but that ruling says this could have happened in any industry.
All right, so we'll leave it there. Michael Venuto of Torosso Investments, thank you so much. And Bloomberg's Vildana Heinrich. Now, coming up, Jerome Schneider from PIMCO, the manager of the largest active bond ETF, tells us why his fund trumps money market funds. And speaking of fixed income, those ETFs took in more than $150 billion in the U.S. last year, the most on record. However, that is still just shy of the sum netted by their stock counterparts, which is good news for Eric, who wins a sushi lunch from Todd Rosenbluth. You'll need to pay up, Todd. And reminder that you can catch all our charts on the Bloomberg at GTV Go. This is ETF IQ. I'm Scarlet Food. This is ETF IQ. It's time now for the ETF Lifecycle, which has 3 main stages. Step 1 is the filing. First Trust partners with Horizon Investments to register a managed volatility small and mid-cap ETF. Ticker HSMV will be actively managed to capture upside price movements in rising markets and reduce downside risk in down markets, focusing on small and mid-caps. Step 2 is the launch. Luthold Group enters the ETF world with its first fund. The Luthold Core ETF, ticker LCR, is actively managed and uses a quantitative approach to invest in other ETFs. The funds it targets can have exposure anywhere globally, but they're all listed in the US. And oftentimes the final stage is liquidation, but in this case, it's reincarnation. The Flag Forensic Accounting Long-Short ETF, also known as Flag, is no more because it's changing its name, its strategy, and ticker in a complete retooling. Exchange Traded Concepts will turn the fund into the North Shore Dual Share Class ETF, ticker DUAL. This fund will invest in companies that issue at least 2 types of stock incorporated in the U.S., usually one to the public and the other to the company's founders and executives. Let's get passive aggressive now and track the tensions between active and passive investing. 2019 was a banner year for fixed income ETFs, with flows almost outpacing equities for the first time since the global financial crisis. So where do the opportunities lie now? Let's check in with Jerome Schneider, who manages the largest actively managed bond fund, PIMCO's Enhanced Short Maturity ETF, better known as Mint. Jerome, great to see you.
Thank you very much. Happy New Year.
Happy New Year. So Mint is the largest actively managed bond ETF out there on the market. So naturally, investors want to hear your outlook on rates. How is Mint positioned for 2020?
Mint's positioned simply for capital preservation, liquidity management, and managing volatility within the broader marketplace. Quite honestly, what we think about where we are in the current environment is that optimism prevails, but uncertainty reigns. And we see a lot of potential obstacles which could emerge at any point in time, whether they're geopolitical, political, fiscal, monetary policy, which appears to be on the sideline at the moment. The reality is the culmination of these events could actually lead to a certain amount of uncertainty for investors as we get further on into 2020. So thinking about that in a more healthy way, having a more balanced approach to liquidity management, having a more balanced approach to portfolio allocations, which help reduce the exposure to volatility, is really the segment that we need to be emphasizing to investors as we embark here at the new year.
Okay, you mentioned monetary policy on the sidelines. You hang out at the short end of the yield curve. Right. How confident are you with the Fed's handling of the repo market disruptions?
Right, we've avoided the repocalypse, so to speak, and really what we've seen is that the protocol that the Fed has put in has frankly alleviated a lot of the symptoms within the repo markets. At PIMCO, we actually look into see the repo markets as a very much a focal point, a barometer of the overall health of the capital markets, the cost of capital in real time. So for us, it's just as much as a real-time warning system to what capital could be doing, moving and fluxing throughout the marketplace, as it is an opportunity set. So when repo rates moved higher in September and October of last year, we viewed that as to be an opportunity. So as an active manager, we segued into those markets. But really what we need to be focusing on is that these are going to be temporary episodes of liquidity. And again, for investors, what they need to realize is that ultimately the cost of liquidity is overestimated, meaning people just take it for granted. We need to be utilizing that with a more proactive solution. And that's exactly what we utilize in the short duration space at PIMCO.
All right, we just showed a chart about cash battle, and I want to talk to you about cash sweeps because they're back in play with Schwab and Zero Commission Trading and a bunch of other firms as well. You recently wrote a blog post making the case for using Mint instead of keeping cash in money market funds, taking a bit of risk for a bit more return as well. What's the risk of doing so? What could go wrong?
Well, most of the strategies that we have out there are same-day liquidity, T+1 liquidity, we like to call it. The reality is that when you move to that segment of space, you are taking a little bit of risk, meaning, one, you're moving into a slight credit space. Again, it's high-end quality credit, but you're actually getting compensated to do so. So you're earning generally between Treasury bills plus 60 to 90 basis points. Mint last year produced a gross return of about 3.5%, a little bit more than that. So there's a fairly healthy compensation in doing so. At the same time, maintaining diversification in your portfolio, being up in quality, and most importantly, earning that kind of yield with having a very short amount of interest rate exposure is actually something that's quite attractive in the portfolio positioning for clients. So what we're really finding is that the clients are wanting to avoid zero returns, so cash sweeps. They're wanting to avoid T-bills, which are structurally subdued lower, and are looking to take that incremental position not only into short-term space like Mint, but into low-duration spaces like low-duration ETF, ELDR, to sort of garner that income and earn those liquidity premiums within the portfolio. And that takes an active, cognizant allocation for investors to take that initial step.
Right.
So the zero fees actually incentivize people to take that step and actually look to their portfolios to see how they're actually properly managing their cash allocations.
All right, now I wanted to ask you as well about your new fund. It's a sequel to Mint called eMint. And according to Bloomberg Intelligence data, there are some 102 ESG products out there in the market with an average of $200 million in assets each. That's more than an average of that's a lot lower than the average of $1 billion for other ETF categories, as you can see right here. Where's the demand for ESG funds going to come from? And how come it isn't here yet, despite all the hype?
Well, quite honestly, it took a long time for us to be talking about fixed income ETFs, and fixed income ETF growth has actually done quite well, doubled over the past 2 years.
From a small base.
From a small base, granted. And right now, actively managed fixed income ETFs represent 10% of the fixed income ETF universe. So as we sort of see this, we're combining it with a new theme, which is ESG investing, social governance, people being socially aware with how they're allocating their cash.
Sure.
So the natural segue is for investors who have cash management, who want to think about capital preservation, but who are yet socially minded, to combine those two. So we actually think there's fairly healthy demand, not just within the short-term cash space, but within the ESG product space in general. At PIMCO, we started our ESG efforts back in 1991. So this has been a long-held tradition at PIMCO, not only in terms of thinking about credit risk and thinking about proper investing, but also looking to bring that to clients. So what we're doing is simply piggybacking off of our enhanced cash expertise and using our platform for ESG products and bringing those together for investors. So we're quite excited about it.
All right, Jerome Schneider of PIMCO, thank you so much for coming in today.
Thank you very much.
Now coming up, we dig into 2 cash cow ETFs, funds looking for companies with strong cash flows, healthy balance sheets, and that trade at a discount. This is Bloomberg. I'm Scarlet E. This is ETF IQ. Now, for every ETF that offers exposure to an asset class or a sector, it's not long before others follow suit. Long a value trap, the beaten-down energy complex is now getting a second look because of increased tensions between the U.S. and Iran. So where does that leave oil pipelines and other infrastructure? First Trust ETF strategist Ryan Isakainen is here now with us to discuss. But before we get to him, Eric Balchunas is going to give us the drill down into First Trust Fund.
Thank you, Scarlet. EMLP, it's actually the largest active equity ETF on the market. It's a MLP-ish energy fund because it only has 25% MLPs. If you go over that, you have to have a different structure. So this way, it's a 40-act fund. That's a detail that's important to some people, but that will mean less yield. That's the trade-off. It's huge at $2.8 billion, 95 bips, a little pricey for an MLP-type fund. Let's look at the holdings. And you only got 25% MLP, so what else do you put in there? You put in pipeline companies and utilities. So you're going to see a mix of that here. Again, that's why the yield would be more like 3% versus 8% for an AMLP. Let's look at the returns of this versus AMLP and a utilities ETF, XLU. And you can see this one's going to be right in between it, right? Because it's a mix of MLPs and utilities. Here's EMLP. So, Scarlett, I think this is good for people who don't like that tax issue on some MLP funds and want the active hand.
All right, got it. Now, still with me is First Trust ETF strategist Ryan Isakainen. So, Ryan, EMLP clearly is kind of a hybrid ETF in that it has both utilities and these MLPs, master limited partnerships. How exposed is EMLP to rates versus, say, oil prices?
Yeah, well, part of the active selection of EMLP is to avoid companies that are more correlated to the fluctuation in oil prices. And so within the MLP segment, we're not selecting MLPs that have had more exposure to exploration production, but more the pipelines that are less correlated. And the same is true with the other portions of the portfolio. We don't want to have something that is negatively impacted to fluctuating oil prices. In terms of interest rates, the utilities portion, obviously in the near term, sometimes you see some correlation negative with rates. But longer term, what we found is actually the impact on utilities when rates go up is not nearly as bad as most people think.
Okay. Now, we were talking earlier, Eric, about the biggest ETF issuers in 2019. First Trust coming in 5th place.
Yeah, and you were the largest active ETF issuer. I think most people will be stunned, PIMCO's too. I want to get your thoughts. You've done it the transparent way. Now you have active non-transparents about to just flood the market. I call it the ant invasion. What do you think of that? Do you think that's going to change this over the next couple of years? Are you worried about this coming competition?
I wouldn't say that we're worried about the competition. We can always utilize some of these non-transparent forms of ETFs should we choose to at some point in the future. At this point, the strategies that we have put into place within our actively managed lineup, we're very comfortable with disclosing our portfolio on a daily basis. And that actually has a benefit to investors, right? They can know what they own. That's one of the key features of ETFs, and they can know where their returns have been generated. And they haven't really, we haven't seen a negative impact on returns, especially when we have less turnover in some of these strategies and a lot of fixed income strategies.
I'm still impressed by the fact that you're the 5th biggest issuer in 2019. You're clearly getting a lot of assets, and I think part of it is you guys seem comfortable with spending money when other firms may be cutting back. We hear stories about rented baseball stadiums. Is that your advantage? Is that the secret to sidestepping the Vanguard effect?
Yeah, I'm not sure who rented a baseball stadium, but it certainly wasn't us. One of the ways that we've chosen to invest is not through a lot of our competitors might hang a sign in left field in a baseball stadium. We would rather spend money in educating the investment professionals that use our funds, because they're really the ones that are best suited to make their clients money and to make those best decisions for their clients. So that has been our focus. We want to focus on investment professionals who know how to use our funds.
Speaking of one of your funds, I've always liked this fund, TDIV. It's the tech dividend. It used to be an oxymoron, but now they're yielding more. Tech's got a great run. These are like conservative tech names, the old 90s type tech names, Apple in there, but still Intel, Cisco. What's the case for this in the coming decade as a play to be tech but not have high beta?
Yeah, so one of the interesting things about the technology sector is it's the most underweight sector in most equity income strategies. If you compare them to the S&P, biggest underweight is to tech. And at the same time, technology stocks pay more in dividends than any other sector in the market. And so where we see this fund being used by investment advisors most often is as sort of a bolt-on to those equity income strategies. Where you're underweight technology, here's a great way to have technology companies that pay a yield, that are more mature, and that are actually raising dividends faster than any other sector in the S&P 500.
All right, kill two birds with one stone, in other words.
Absolutely.
Ryan Isakainen, thank you so much, of First Trust. Now, we like to say that the ETF industry has something for everyone, and for those intent on milking returns from cash cows, check out this week's There's an ETF for That. Cash is king when it comes to a couple of Pacer U.S. Cash Cows ETFs. First up, Cows, which screens the Russell 1000 for the 100 biggest companies based on free cash flow yield. The second fund trades under the ticker CAF and has the same objective, but uses the S&P Small Cap 600 index. Both funds have had success looking for companies with strong cash flows, healthy balance sheets that trade at a discount, and show long-term potential. They also weight their holdings according to each company's 12-month free cash flow, capping each name at 2% at the time of the quarterly rebalancing. Cows includes names from Micron and Lam Research to Cisco and Fox. By contrast, CAF features Michaels, Warrior Met Coal, Contour Brands, and Meritage Homes. There's a big divergence in size, too. Cows is significantly bigger, attracting roughly $250 million in assets, while CAF has drawn some $50 million. Cows has a lower expense ratio as well. Bloomberg Intelligence gives both funds a green light, with a notice for their alternative weighting. So that's Pacer. We just talked about First Trust, and both of these firms are able to get a lot of assets, even though their expense ratio is not particularly low.
Yeah, they should be models for how to do it, and the key is sales and hustle. You talk to people, advisors, they're like, they got the best salespeople, they're persistent, and I think that can matter, and that is one way to get yourself immune from the Vanguard effect.
Nothing replaces that legwork then. All right, that does it for Bloomberg ETF IQ. Be sure to catch us each Wednesday at 1 p.m. New York time, 6 p.m. in London. From New York, this is Bloomberg.